I think fixed income makes a great investment choice. But our job as fixed income asset managers is to engage in that risk mitigation. And if I were the Fed, I'd start thinking about going ahead and lowering rates. I don't necessarily think success is about sharp elbows. It's really about creating a great team, to be thoughtful with regard to leadership.
While most sixth graders are simply trying to get through school, Ann Walsh, a self-proclaimed military brat, was already fluent in the language of business thanks to her father.
When I was in the sixth grade, my dad was also an investor, so we used to talk about business quite a bit around the dinner table. And I actually knew and understood bond math in the sixth grade. So I think it was predestined.
Walsh earned her accounting degree from Auburn University at the age of 19, and she soon found an opportunity to put her skills to use.
My first job out of college was at the retirement systems of Alabama. One of my first assignments was to monitor the private placement covenants. And it was one of those moments where I kind of went, I don't know what I'm doing, but this looks like I could benefit from having a law degree.
Walsh pursued an MBA at Auburn, then enrolled in law school at the University of Miami. She studied at night and worked full-time by day. Walsh took on roles in fixed income and insurance. In 2001, as CIO of Reinsurance Group of America, she crossed paths with the late Scott Minerd. At that time, she was a client of Guggenheim. A conversation with him eventually changed the course of her career.
One day I said to Scott, I'd like to switch gears. Would it be possible for me to come work with you and for you? He said, yes, Ann, but the Chief Investment Officer title's already taken.
In December of 2022, Minerd passed away, leaving the CIO seat vacant. Walsh eventually stepped into that role. Today, she serves as the Chief Investment Officer of Guggenheim Partners Investment Management, the global investment management division of Guggenheim Partners. Walsh now oversees nearly $350 billion in assets. Walsh says the firm's investing philosophy is centered on minimizing losses, not chasing returns, especially when it comes to managing risk.
We are caretakers of our clients' money. At the end of the day, whether it's an institution, a pension plan, insurance client, they have policyholders, there's an individual whose money we're protecting and taking care of.
So let's go right to the heart of what the investment world is thinking about these days. The President of the United States, as we've talked recently, has been interested in having lower interest rates. Based on the data that you've seen, do you think it's a good idea now for the Federal Reserve to lower interest rates?
Well, I think there's two elements here. The Fed doesn't want to lower rates and appear to be kowtowing, if you will, to President Trump's language. On the other hand, I think there's actually room for them to lower rates. If you look at the Fed's Beige Book, which the Fed reacted to last year when they started lowering rates, I think there's room for them to take action now. And if I were the Fed, I'd start thinking about going ahead and lowering rates. Real rates are very high right now relative to history, and of course we have a pretty significant term premium built into the term structure of interest rates right now.
So let's talk about the Fed's goal, which is 2%. Is that too low a rate to really get to at this point? And does it have to be at 2% or in sight of 2% before the Fed should lower?
They have a credibility issue right now. The Fed has to get to 2% because that was the target that they set. Although they've already started to project that they're willing now to target a range of inflation, which I think is the approach they should have taken all along. But they're going to get to 2%, and I think the trajectory is still in favor of the Fed's 2% target.
Are you worried that the annual deficit, which is now approaching $2 trillion a year, and the total indebtedness, which is over $36 trillion, might be too much to sustain this bill passing the Congress? Or do you think the debt is really not as big a problem as people make it out to be?
So I tend to be in the camp of when you incur debt, you end up having to pay it back. With the rise of modern monetary theory, which has become in vogue in the last several years, particularly in Washington, which is the belief that if you print money, if you have the reserve currency, you don't actually have to ever pay that debt back. And so mounting levels of debt and deficit spending are fine. I don't buy that. I think there's a point at which the U.S. government has to be able to sustain itself. Because the cost of interest is going up for the Treasury, all of this just continues to accumulate. I think it's very difficult for our friends in Washington to get to the point where they're going to be able to return to levels of spending from pre-COVID. But in order to actually get that trajectory to settle down in terms of the future levels of debt, they'd have to return to pre-COVID levels of spending. I don't see that kind of willpower in Washington, so I think spending will continue. I think that we're going to continue to see real significant issues amongst bond buyers, and I think that as a result, the term premium has definitely gone up because there's a sense of more risk in the U.S. as a result of all this spending. I'm of the camp, we need some fiscal hawks.
Are you worried about our reserve currency status, given the fact we have so much debt? And do you worry that in the end, we will not be able to be the only reserve currency if we continue borrowing at this rate?
My view on the reserve currency status is that there's not really an issue right now. I don't see another currency coming in to replace the dollar. 70% plus of all transactions are conducted in dollars. And I think that gives us a unique benefit for the U.S. government. And I think the government has to be thoughtful with regard to being responsible to U.S. Taxpayers, responsible to our position globally.
Guggenheim Investment Management manages equities and debt, but more debt than I think equities. Are you worried that private credit, which has grown very dramatically in recent decades or so, is something that should be regulated by the federal government?
What we've seen in the U.S. is a very significant shift in the capital markets over the last, we'll call it, decade plus. And that is a move from a more public market to more private. And you yourself would know certainly the movement towards private equity-owned companies. I don't think that's a bad trend. I've been personally involved, and Guggenheim has been, for decades in private credit. What it's done is expand. And I think private credit providers can be much more nimble and can be more responsive, particularly to these private equity-owned sponsors. But additionally, what we're seeing is a huge growth in the need for capital. And traditional providers of that capital, whether it's banks or the public markets, have been shrinking their participation with private capital stepping in. Now, the question about regulation. I know regulators, particularly bank regulators, had been concerned, and I think remain somewhat concerned with regard to how to address this because of the lack of transparency. Lack of transparency doesn't necessarily mean that those credit markets are bad. It just means that they're not necessarily quite so visible.
For the average investor who may not understand the fixed income world, if interest rates go up, that means that bond prices go down, because the theory is if interest rates go up, the previous bonds that were sold at a lower interest rate, therefore they're worth less. So today, though, for the average person who wants to invest in fixed income, should he or she say, well, interest rates may be coming down, bond prices might go up, I should wait a while, or should somebody say it doesn't make a difference whether you pick it now as the time to invest in fixed income or wait till later?
The fixed income markets are a very large and broad market. I think critically, you should be an active investor. And that means that avoid the passive vehicles in fixed income. Why do I say that? Well, that's because in fixed income, you have very little opportunity for upside, except as rates come down, relative to, say, equities, where you have this opportunity for prices to go up as well as go down. So what's the key aspect to fixed income management is risk mitigation. You want to avoid any kind of risk of loss, whether that's from rates or whether that's from default risk or downgrade risk. And so as a result, being an active investor is critical. That's the first part. The second part is that we do believe that rates will ultimately come down. We do believe that the Fed will ultimately continue its trajectory of lowering rates at the front end of the term structure for rates. So we think that's a positive. So as rates come down, prices will go up. And that will be across the board in all the different sectors, absent a recession, of course, which is not in our projection at this time.
Historically in this country, we have recessions roughly every 7 years or so. Do you foresee a recession coming in the next year or 2 or 3, or are you not that worried about it?
We've had a bifurcated economy. So those with access to capital, those at the higher end of the income earning spectrum, they haven't suffered. And so overall, what we've seen is a non-recessionary environment and a resilience to the U.S. economy. We anticipate that we're slowing down in the U.S., that what we're seeing from the Beige Book and other indications are that the market, that, where we would have seen the economy kind of on the boil in the past, that boil's coming off. And so as a result, things are slowing down, but we don't believe to recessionary levels at the aggregate. And so I think that's our expectation is we will slow down to below trend growth, but not fall into recession. Having said that, the tail risks are higher than they have been in the past, and there is a lot more volatility and uncertainty with that expectation. Our recessionary expectation is probably about 30-35% right now. One day I said to Scott, I'd like to switch gears. Would it be possible for me to come work with you and for you? He said, yes, Ann, but the Chief Investment Officer title's already taken.
So for those who may not be that familiar with it, fixed income or private credit, it basically you're putting up money with the expectation you're going to get your money back and a rate of return during that interim period of time before you liquefy your investment, right?
Right.
Okay. So let's suppose I say I have no risk tolerance. I don't want to lose principal. I just get the lowest interest rate I can. I want to get my money back. I should buy a treasury bill. Is that the safest thing theoretically?
So you've just hit on something that's really important, and that is the fundamentals of the way Guggenheim thinks about fixed income and, frankly, investing in general. We are one of the few, if not the, home of behavioral finance. So Dr. Danny Kahneman, who's really the father of behavioral finance, and he wrote a book, Thinking Fast and Slow, really brought to light about how investors perceive risk. And so to your question, what does an investor do when that's the way they think about risk? Well, I think fixed income makes a great investment choice. But our job as fixed income asset managers is to engage in that risk mitigation, all the tactics that are necessary in order to ensure that we are minimizing risk for our investors.
Let's suppose I'm a risk mitigator. I don't want to take any risk.
Right.
I want to get my money back. Mm-hmm. I want to buy a treasury bill. What kind of return am I going to get on a treasury bill?
Well, right now, you're getting over 4%.
4%, okay.
So that's not bad for a very short-term, no-risk investment.
Well, suppose I say I have a great confidence in the U.S. government. I'm willing to buy a 30-year treasury bill. I'll get my principal back in 30 years. What kind of interest rate would I get for that?
Well, right now, you're getting 5%.
Let's suppose I say I want to buy a treasury bill, but Guggenheim, I assume, like most money managers, charges a fee. Why don't I just go down to the U.S. Treasury Department, and when they have an auction, I just show up and say, I want to buy a treasury bill. Why do I need an investment manager to get me a treasury bill?
Well, that's because we're not going to invest just in treasury bills. We're going to invest in all those other aspects of the fixed income market that add value for our investors.
Okay, let's talk about how you became an expert in this area. So where did you grow up?
My dad was Air Force, so I kind of grew up a lot of different places and a bit of a military brat. But I spent a lot of time in Washington, D.C. in the suburbs.
And when you were a little girl, did you say, I want to be a fixed income money manager?
Well, it's funny you should ask that question. When I was in the 6th grade, my dad was also an investor. He was an accountant by training. And so we used to talk about business quite a bit around the dinner table. And I actually knew and understood bond math in the 6th grade. So I think it was predestined.
Okay. So where did you go to college?
I went to Auburn. I was an accounting major.
Yeah. Mm-hmm. Okay. Then you got an MBA as well?
Yes.
After that, you went to get a law degree. Now, usually lawyers get a law degree, and then they say, I really want business. Then they go to get an MBA. It's rare that somebody says, I'm in business, I know business, I have an MBA, and then they want to be a lawyer. So how did you come to that pattern, which is unusual? Purely
by happenstance. So my first job out of college was at the retirement systems of Alabama. One of my first assignments was to, I'm going to put this in air quotes, monitor the private placement covenants. And so at that time, because it wasn't a computerized system, the idea of computers were to walk me into a room full of closing binders and a rolling library of these, open the big book on a desk and say, now here's the covenants, go monitor them. And it was one of those moments where I kind of went, I don't know what I'm doing, but this looks like I could benefit from having a law degree. And so ultimately that's what drove me to the decision to go to law school.
But you were working, you had a job, and then your family say, you're making a living now, you're going to give that up to go to law school, and who's going to support you when you're doing that?
I didn't give it up. I actually went and got my MBA and my law degree while I worked. So I did those at night.
So after you get your law degree, what did you do next?
So I went to, and remained still in investing. So I've been in the investments world 41 years with no breaks, so continual. And I went to work at what was that time called American Bankers Insurance Group, and I became their head of investments when I was 21, actually, and managed their portfolio.
And when were you recruited to come to Guggenheim?
So Scott Minard, who was the chief investment officer, and I met in about 2001. I became a client through my predecessor employer, Reinsurance Group of America, and I was the chief investment officer there. And we had a reinsurance treaty with a client of Guggenheim's. And so Guggenheim was appointed the asset manager. That's how I met Scott. And I was able to be a client for about 5 years when one day I said to Scott, I'd like to switch gears. Would it be possible for me to come work with you and for you? And he said to me, I remember this, he said, yes, Ann, but the chief investment officer title's already taken. So of course, that's been a long-standing joke between he and I at the time. And, but no, we worked together until his sad passing 2.5 years ago.
Guggenheim was started when?
So Guggenheim was originally, I think, the family home office, but in its current form was basically founded in 2000.
And so the asset management function is the biggest part of Guggenheim today?
Yes.
So Guggenheim today is a privately owned firm. It's not publicly traded. Does it have any plans to do anything different? Or as far as you know, it's basically going to stay as a privately owned company?
Absolutely.
Your client base, is it institutions or individuals or both?
Both. Both. We have retail mutual funds. We have high net worth separately managed accounts. We have institutional clients. We like to meet our clients where they are and being able to provide our strategies to them. We are caretakers of our clients' money. At the end of the day, there's an individual whose money we're protecting and taking care of.
I haven't interviewed that many chief investment officers of gigantic investment firms like yours who are women. Now, when you got into this business, were there very many women who were rising up to become chief investment officers of multi-$100 billion investment organizations?
I can't say that there were. We were quite rare. In fact, up until very recently, when you looked at the number of portfolio managers that were women, only a few years ago it was about 10%. Now at Guggenheim, we have about 30% of our workforce is female, and that actually is at the higher level. So we have a long way to go to get to the point where women will be able to advance into chief investment officer roles.
So if somebody is graduating from college today, male or female, and he or she says, I'd like the fixed income world, is that a good career for somebody? Would you recommend to somebody they get into the fixed income or the private credit world as an investment manager? Or would you say go into something like private equity?
I think this is a very, very solid investment career or career for any young person. A couple of reasons. Very importantly, we are caretakers of our clients' money. At the end of the day, at the end of every investor, whether it's an institution, a pension plan, insurance client, they have policyholders, there's an individual whose money we're protecting and taking care of. We are caretaking their savings, whether they're saving money for retirement, whether they're saving money for their kids' college, whatever. And so that's very important. It's very purposeful. Our particular management style is one that's very team-based and collaborative, and in that way, it makes a wonderful career for young people, and particularly young women who want a collaborative workforce opportunity, and they also want a purposeful career.
Now, in the investment world today, there's been a push to get people to come back to the office, to actually be in the office physically. Do you require all of your employees to be in the office, or you can do it on a screen? It doesn't make much difference in your business.
So at the end of the day, this is a people business. Our mission is to serve our clients. The best way we can do that is to be together. It's also important because generationally, I mean, I've been in this business 41 years. I suppose I could work from home pretty easily. I know what I'm doing, but I wouldn't be transferring my knowledge to young people that way. It's not as convenient. It has to happen day in and day out as our younger people are observing the behavior of our more senior team members. And that interaction is very important, and it has to be done in person.
Now, in recent years, parents who want their children to get jobs in the investment world obsess over having their children be a STEM major. Suppose somebody applies for a job at your firm and says, look, I'm a philosophy major, I'm an English major, I'm a history major. Does that person have any chance of getting hired?
Oh, absolutely. I really look for characteristics relative to hiring to a resume. Critical thinking, intellectual curiosity, grit. This is an industry where you're going to work hard and you're going to work a lot of hours. And that's okay, but that's the person and that's the set of characteristics that I'm really much more interested in.
If I had $100,000 and I came to you and said, what should I do with it? What would you do with $100,000? You recommend it to somebody else?
Right now, because of all the volatility in the economy and in the world, I would say a diversified portfolio with $100,000 is the way to protect against risk and to provide the kind of return. So I would have a little bit of everything in there. Fixed income, again, with a knowledgeable manager. Equities, because I think the equity markets will continue to be solid, if not without some volatility, of course. I throw in maybe a little bit of Bitcoin, interestingly enough, maybe a small amount just for speculative holdings, and just create a very diversified portfolio against the risk.
So what would you say are the most valuable lessons you've learned as an executive on a Wall Street firm?
I think you have to be humble, because investing through cycles means that you're going to make some mistakes and you're going to learn some very important lessons. And to be thoughtful and not to have knee-jerk reactions to or overreact to too much volatility, news headlines, really separate the signal from the noise, and to be thoughtful, because these cycles will come and they will go, but to remain thoughtful and a long-term investor. Those are the ways I like to think about risk and managing through all the different timelines that we are going to continue to invest in.
To succeed in Wall Street, most people would think on the outside you need to be tough, you need to kind of go after your competitors, you need to really be a difficult personality. What does it really take to succeed in Wall Street?
I don't necessarily think success is about sharp elbows. It's really about creating a great team, to be thoughtful with regard to leadership, to have a long-term view, to work really hard. This is a business where it's important to be dedicated, and I think that's the elements to success. All the other ones, which are table stakes, intellectual curiosity, critical thinking skills, understanding the markets, having great analytical skills, that's all table stakes, but it's how you do what you do that makes the difference. And I believe that, as much as anything else, is creating a great team, and ultimately great results will come from that.